Welcome back to another episode of Investing Explained. Here's today's question. We have to define three different terms here. The nominal interest rate, which in your example is 10%. Inflation, which you mentioned to be 8%. And then the so-called real interest rate, which is the difference between the nominal interest rate and inflation. So when you ask how much should you pay to the bank, well, that is 10% in interest. So if your mortgage is $100,000, your interest payment is $10,000. Now we also have inflation, which is vitally important because inflation ensures that the nominal value of money goes down over time. So think about it like this. What you can buy for $100,000 today, you need $108,000 to buy a year from now. This is great if you borrow money. Imagine that you own a small store or perhaps just get your regular paycheck. Because goods or services are normally getting more expensive with inflation, typically what happens is that your annual nominal income will also go up and you will therefore be able to pay back your mortgage with future dollars. While what you see in your bank statement is $10,000 in interest rate payment, it will, because of the effect of inflation, feel like you're only paying 2%, which is the so-called real interest rate. You pay back with future dollars that had lost 8% in value. So that's really why. We call this the real interest rate because that is the actual cost to us. We're sort of getting 8% for free, more or less, as a borrower due to inflation. And then we just have to pay the actual real interest rate of 2% to the bank. I know there were quite a few numbers to keep track of there, but I really hope that this simplified explanation makes it clear what's the nominal interest rate, what's inflation, and what is the real interest rate. That's it. Preston and I will continue explaining investing, so go ahead and hit that subscribe button.